It took only a matter of hours for the 16th largest bank in the United States to go from stable ground to underwater.
I am pretty concerned.
Silicon Valley Bank was a go-to in the tech world. Decades of experience turned it into a leading lender for startups. Now, its sudden and abrupt downfall has trapped billions in investments and deposits.
A little nerve-wracking when it comes down to how you keep operating your company.
The concern started midweek when, in need of assets, the bank sold off bonds, but at a loss. Its capital shrank and resulted in the beginnings of a bank run. By Friday, federal regulators swooped in to provide financial guardrails.
That's what they were doing, was protecting the deposits of those up to $250,000, and then they have a way to unwind the rest.
That could throw a wrench into some companies' finances if they're unable to access money beyond the insured $250,000.
When banks experience financial losses, it is and should be a matter of concern.
Before the dust could settle, markets were rattled and sell-offs could bleed into Monday. Blame is being partially laid on high interest rates, with the Fed now walking a tightrope.
On the one hand, they're trying to tame inflation, and in the process, they might tip the economy into a recession. At the same time, we have this emerging financial instability risk.
This is the largest bank failure since the 2008 crisis. And while niche banks tied to one sector may feel stress, major institutions are likely to avoid catastrophic loss.
The reforms that were put into place back then really provide the kind of resilience that we'd like to see.
Silicon Valley Bank did have operations in Canada, and the big banks felt the squeeze, erasing nearly $20 billion in value on Friday. Many of them have acquired regional banks in the U.S., increasing exposure to this bank's failure.